got your point this morning. Want to let Kevin Kosar respond. How many years have you been a postal worker, though, before you go?
Mr. Pollack, you've had lots of time to reflect on your testimony, so you are now recognized to deliver that testimony.
Thank you, Mr. Chairman, and thanks to all the members of the committee. The discussion draft of the Bipartisan Housing Finance Reform Act develops thoughtful approaches to central issues in the reform of American housing finance. I remind us that this housing finance system collapsed twice, once in the 1980s and again in the 2000s. The developments of the 1980s to the 2000s concentrated mortgage credit risk on the banks of the Potomac in Fannie and Freddie. Obviously, this was a major blunder, but the concentration continues. A principal objective of the bipartisan draft is to move mortgage credit risk from the government to private risk capital and to systemically put more private capital in front of the government's mortgage risk guarantee. Like my colleague Norbert, I am no fan of having the government guarantee the mortgage market, but at least putting skeptical, professional, and non-political capital in front of the government's guarantee would be progress. In my view, we should be headed for a system which is 80% private and only 20% government. The bipartisan draft would move us in the right direction, and in my view, that 20%, by the way, should be the FHA. I suggest 5 additional principles for the Congress to consider. 1, the best place for mortgage credit risk to reside is with the lender who makes the loan in the first place, even though the loan may be funded in a securitization. For that originator to retain significant credit risk, skin in the game, for the life of the loan assures the best possible alignment of incentives for good credit management. Nonetheless, the majority of the American housing finance system came to be built on exactly the opposite theory, with disastrous results. A lender's skin in the game should be encouraged by law, policy, and regulation. 2, an essential economic link is that easy credit standards and cheap mortgage credit get capitalized into house prices. By trying to make houses more affordable, the government subsidies and underpriced guarantees make them more expensive. All housing finance reform must confront this paradox. 3, underpriced government guarantees are sources of mortgage credit distortions and disasters. Fannie and Freddie got a free guarantee from the Treasury, which was the ultimate in underpricing. If there are to be any government guarantees of mortgage credit, as there would be in the bipartisan draft proposals, how such guarantees are priced is an essential consideration. And the correct principle for setting the price has already been enacted by the Congress for Fannie and Freddie in the Temporary Payroll Tax Cut Continuation Act of 2011, Title II, Section 401. This tremendously important enactment is almost unknown and has scandalously not been implemented. It should be. 4, the bipartisan draft would replace the current Fannie and Freddie with a complex set of new institutional structures and relationships. It's impossible to know in advance how complex systems will behave as circumstances change in unanticipated ways, as they always do. We should certainly not rely on any special foresight in the Federal Housing Finance Agency or in Ginnie Mae to deal with this problem. An alternative approach to Fannie and Freddie would be to continue their current operations but treat them for capital and regulatory purposes the same as every giant bank, including making them SIFIs. This would automatically remove the regulatory capital arbitrage which drove their excessive expansion and excessive riskiness in the past. 5, the bipartisan draft provides for a larger role for the federal home loan banks in securitization of conventional mortgage loans for smaller financial institutions, and this is definitely a good idea. In addition, I recommend that the home loan banks be authorized to form a joint subsidiary dedicated to mortgage finance, including securitization, but also in particular advancing structures with a lender skin in the game on a national basis, and this would be especially advantageous for small local lenders everywhere in the country. In conclusion, as the bipartisan draft proposes, we need to move to a system with more robust risk distribution if we want to have sustainable home finance, and thank you very much for the chance to share these views.
Thank you, Mr. Pollack. He yields back. Chairman Hensling has to step out for a short period of time, so we've stepped in. We begin the questioning of the witnesses, and I'll recognize myself for 5 minutes. I want to begin with an issue that's really important to me, and I've seen this develop over the last several months, and that's CECL. To me, I think it has a direct impact on what we're talking about here from the standpoint of affordability and accessibility to loans in the home mortgage lending area with regards to low and moderate income folks. And so I guess, Mr. DeMarco, you've headed the FHFA before. What do you see would be the effect of CECL on the FHFA, the Freddie and Fannie, even Ginnie Mae, if we're transitioning that way, in that they have to reserve for this, and they don't have the capital to set up a reserve. So in my mind, they would have to charge more in guarantee fees or a surcharge of some kind to put into a reserve, and that would cost a lot of extra money. So can you, to the borrower, can you tell me what your thoughts would be on that?
Certainly. I mean, in general terms, yes. I mean, the imposition of this change in accounting standard is going to require Fannie and Freddie to increase their reserves because now it's a life of loan reserve, not one that's based upon known and expected losses. But it's not just Fannie and Freddie. I mean, the bigger impact really is going to be among the lending institutions themselves that are facing quite a change in their reserving here. I am somewhat encouraged by recent discussions taking place to see if there's to take another look at this impact and how to address it.
My concern is that it's going to raise the cost of borrowing to the consumer. Have any of you looked at this yet to see what you anticipate the cost to the consumer to be at all with regards to CECL? Ms. Johnson, you're in the home mortgage lending business, no? Okay, let me rephrase the question this way. If we have to raise the cost to the consumer 50 basis points, how many consumers would no longer be able to have access to home mortgages? Does anybody have an answer to that question? That's concerning.
Hi. Yes,
Mr. Stafford?
I'm the president and CEO of Tower Federal Credit Union locally, and it is quite concerning any cost that this current proposal or any future proposal to raise any type of fees or G fees, including any regulations such as CECL that would add a burden. It is very concerning from a credit union point of view, especially in rural areas. It would be detrimental to some areas. And so I would strongly encourage the Congress, both with this proposal and future proposals, to be very cognizant of raising any type of fees beyond what we're doing today.
Do you see if the credit unions have to raise their rates 50 basis points, what is the normal number of people that can no longer qualify for or even want to be able to borrow at that point? Do you have a number on that?
I don't have an exact number. I'll be more than happy to get that.
But it is a deterrent. Would you acknowledge that?
Yes.
Would everybody on the panel acknowledge the fact that if you raise the rates 50 basis points to cover this extra cost, or whether it be a surcharge or however you want to do it, this is going to be a deterrent to people being able to get access to credit? Would everybody agree to that point? Anybody not agree to that point? Okay, thank you.
Mr. Chairman, for every $1,000 increase in the cost of a home, 100,000 people are priced out of the market for that house.
Okay, what was that again? For every
$1,000 increase prices out 100,000 people out of the market.
Every $1,000 cost in a loan.
Prices 100,000 people out of the market.
100,000 people out of the market. Wow. Okay, so this would be significant, especially on low and moderate income folks. Okay, thank you. That's the point I want to get to. Okay, very quickly, with regards to, right now we have, within the description of the bill here, we still have a government backup. And so, technically, the government is not backing it up, the taxpayers are backing it up. And I know Mr. Royce has got a bill, and I support it, where he is going to ask all of the folks throughout all the agencies in government to take a look at wherever we as a government are guaranteeing things, basically putting the taxpayers on the hook, why can we not use private reinsurance? So what would you all think about requiring these different entities to have reinsurance to protect the taxpayers if we guarantee these loans and have the agency have a policy behind that. Ms. Johnson, you're in the mortgage industry. I'll guarantee you all your companies got reinsurance, do they not? Okay.
They absolutely do.
Anybody have any thoughts on that very quickly? I'm out of time already. Yes, sir, Mr. Pollack.
Mr. Chairman, I would say that's a very interesting idea which should be tried as an experiment and see what happens, to see what the price of such reinsurance is, because as I said in my testimony, the underpricing of government guarantees is a great source of mortgage lending disasters and all kinds of lending disasters.
Well, if we're going to put the taxpayers on the hook, as we do with TRIA, as we do with flood insurance, and which BOLOs now are starting to put reinsurance into their portfolio of ways to cover that risk, I don't know why we don't need to do it here. My time's expired. With that, I yield to the gentlelady from California, Ranking Member Ms. Waters, for 5 minutes.
Thank you very much. I have 2 questions for Mr. Calaterra. This GSE reform proposal would make major structural changes to our current housing finance system. How do you think the market would respond to transition risk involved? Secondly, small lenders play an important role in our housing finance system today, particularly when it comes to reaching underserved markets. In your opinion, would the housing finance system in this bill provide broad access to mortgage credit for creditworthy borrowers across all markets, including in underserved areas and throughout the business cycle? Are there specific provisions in the bill that you think would help ensure that? And are there additional provisions that you think need to help ensure broad access to credit? I know that's 3 questions or so, but give it a shot.
Okay, thank you. I think the first one was on transition risk, if I wrote it down correctly. There is a concern, we have a large concern with the transition risk, given the changes that are going underway at Ginnie Mae. When we originally were behind in support of the transition to Ginnie Mae, we did that because we felt it was a proven vehicle for funding loans, and it took very, very little risk at the government side. It's never lost money, and it's always provided a good source of funding. But it didn't make the credit decisions that would roll into the second one, which is access to credit. It did control some access by the number of people allowed to be in its program. So the number of issuers in its program allows it, determined how many people and in what way they could get it. So your specific question about transition risk, I see significant transition risks transferring from something that's known to something that's unknown. And I think that what's going on at Ginnie Mae is making it uncertain is exactly what they're going to look like. They have an initiative, a 2020 initiative. It's not going to be done until 2021. And so we're going to be moving to something that's in a state of transition. And I think that poses a lot of risk, first off. The access to credit, we were disappointed with the elimination of the targeted lending initiative. We felt that that was something that was helping middle income, low to moderate income, and minority homeowners enjoy a lower cost of funds. We're not sure. We think that from a 50,000-foot level, maybe the Ginnie is moving off mission a little bit, and we're not balancing out the protection of the taxpayer with the offering, the consumer access to credit and choice. I don't know if I answered that, but I tried.
Do you have any other thoughts that you have not heard expressed here today? Everybody just seems so nice and not wanting to dig too deep and go into too many details. Anything you'd like to share with us about the proposal that you see?
Well, I think our concerns are with the guarantors and the number of guarantors. We think the system right now, we've gone through a very tumultuous time in the housing system, and we've kind of settled, and there's been the Fannie and Freddie today are dramatically different than they were when we got into the crisis. And so I think that a lot of these administrative changes have been very, very important in help stabilizing the market.
I can't hear you.
And so I think those are positive things. I do think there are things we can do in the industry. I don't know if they're particularly specifically identified in this bill.
Such as?
Well, I think that we haven't seen any modernization of underwriting guidelines by anybody in the industry. And clearly, the generations that are coming up today are acting in a much different way than historically the older generations have. I just think there should be at least some thought put to those items.
So what are you referring to? You're talking about perhaps how to deal with millennials who change jobs?
The gig
3, 4,
economy.
5 times,
yeah.
or what? What are you talking about?
Yeah, the gig economy, the social contract, where people are moving jobs much more frequently than they did in the past. There's just a lot of different things that have happened in society that I don't think our guidelines, we've been focused on trying to eliminate risk, and I think at the cost of access to credit and also choice of credit. Not everybody wants to be able to push a button and get a loan. Some people actually need education, and it gets harder and harder if you're not sitting down with someone to convey that, to achieve that.
Let me just, I have a few more minutes, ask Ms. Yentl about the Housing Trust Fund. As I remember it, Mr. Marco, I think I remember that you did not support funding the Housing Trust Fund. And Ms. Yentl, I think you have indicated that you think that's very important. Would you speak to that for a moment, please?
Sure, absolutely. Thank you for the question. We believe that the Housing Trust Fund is essential and should be expanded in comprehensive GSE reform. We believe that because the data are clear, showing that the only segment of the population for which there is an absolute shortage of homes that are affordable and available to them are extremely low-income renters. These are seniors, people with disabilities, families with children, often working low-wage jobs. There is a shortage of over 7 million homes that are affordable and available to them. The Housing Trust Fund was created precisely to fill that need, to fund the development and preservation of rental units affordable to the lowest income people. So we believe comprehensive GSE reform is an opportunity to expand funding for this important program.
Thank you very much. You're back.
Gentlelady's time has expired. With that, we go to the gentleman from Arkansas. Mr. Hill, recognized for 5 minutes.
Thank you, Chairman. Thanks to the ranking member for this hearing. And it's an important hearing, and I'm glad to see everybody in a Christmas spirit today and celebrating with us here on Capitol Hill. This is how we love to spend our Christmas. In the proposal, I appreciated Mr. Michel speaking out for taxpayers, because that really is a big challenge when it comes to the GSE system, whether we're talking about 2000 or 1980 or 1995, putting the taxpayer at the forefront here, since this is a government function. And I'm curious on, first of all, all of you have talked about regulatory importance of regulatory importance here, and Mr. DeMarco ran the agency, but that seems to be a perennial failure no matter what we've done. In the 1980s, it failed. In the 1990s, we put in capital standards, and that didn't accomplish anything. And then in the early 2000s, we reformed the regulatory system, and the system still failed. And so if you would, put up that DTI slide. So looking at FHA right now, you see since the first quarter of 2011, a slide in average credit scores approved by FHA, and you see a dramatic increase in debt to income starting in 2015 from, say, 40% up to 43%. So, and of course, the patch in the government-sponsored enterprises has a slide that looks very similar to this. And to me, that's in absolute direct opposition to this need for regulatory oversight and the rules outlined in Dodd-Frank by the Congress on a qualified mortgage. And I'd like Mr. Pollack, if you could comment on this, because if we're going to put all our faith in this regulated utility type approach, I have seen no evidence in 30 years that federal oversight of the duopoly that we've had during that period of time has been very effective.
Thank you very much, Congressman, and these charts you put up are very important and meaningful. It's a typical thing as house prices are inflating, as they have been for 8 years, that government agencies reduce, and so do private sector sometimes, reduce credit standards, but especially you see it here with the FHA. And these are getting the debt service to income ratio higher and higher is a distinctly risky thing to do. When the market turns down, as perhaps it will before too long, we'll regret that a lot. And the problem is that you have regulators, and I agree with you, and that is not where our faith should go. I had a line about that in my testimony. Don't put your faith in the superior foresight of the regulator. It never happens. That where you have regulators who are like the old Federal Home Loan Bank Board, who are both cheerleaders for riskier lending as well as supposedly safety and soundness lenders. We get that in modern form, and that's a fundamental problem which tilts the risk of the mortgage system to an unwise level. Thanks very much for those great numbers.
Yeah, well, I appreciate that. Switching subjects to low, moderate income people, Ms. Yentl, in looking at the Housing Trust Fund money that's been allocated to Arkansas, I've never really seen it being able to be put out effectively. Have you studied all 50 states that have gotten a Housing Trust Fund allocation, and actually, could you follow with my office and send me what's produced on that? That would be helpful, because I know in Arkansas, the allocation that we've gotten is still sitting in an account unspent. As they say, the regulatory oversight of that money and the ability to use it in any productive way has been, in their mind, not market ready. In other words, it sits in the Arkansas Development Finance Authority and not utilized very easily. So
I'd be very glad to get you that information. We've been tracking every dollar of the Housing Trust Fund to ensure that it's being used efficiently, effectively, as quickly as possible, and for the purposes of which it was intended, and I can assure you that it is being used for those purposes. At this point, the first year's allocation, the 2016 allocation of $174 million, has resulted in about 1,500 Housing Trust Fund funded units.
And those are rental units?
Those are rental units.
So that's $115,000, I guess, or so per unit. Is that a competitive market price? And can you have a reasonable return on that?
So those are rental units. They're affordable to extremely low income households, people who are 30% or below. As you know well, housing construction costs really vary from community to community and differ widely. I think an average construction cost of $115,000 is agreed to as generally average. Some people go a little bit higher for what the average would be. As far as the return on investment, I would love to have more time.
My time's expired. I'm
elsewhere.
Gentleman's time has expired. With that, we go to the gentleman from Connecticut. Mr. Himes is recognized for 5 minutes.
Thank you, Mr. Chairman. And I'd like to begin by thanking the panel for being here and just take a moment to thank Chairman Henschling. While we rarely agreed on anything, I appreciate the way in which we disagreed, including the effort that led to today's hearing and the production of the legislative proposal. One of the areas in which we couldn't find easy agreement, and that led, of course, to the fairly general treatment of the commitment of the new structure to affordable housing, was precisely that. There is a blank there, and I very much appreciate, Ms. Yentl, your specificity in proposing exactly the amount of G fee that should be reserved for affordable housing, as well as the minimum funding, as you put it, for the Housing Trust Fund. Again, there's a blank in the proposal, largely because I suspect we wouldn't have agreed on what it should be. That doesn't reflect our lack or my lack of commitment to affordable housing. So my question, and again, Ms. Yentl, I really appreciate the specificity you put out there. Could you tell us how your proposal, I think it was 10 basis points and $3.5 billion, put that in context for us vis-a-vis historical levels of commitment out of the old Fannie Mae structure, but also how you think that addresses, how much does that actually move the needle on the overall affordable housing problem, just so we can get a sense of what happens if we go higher or lower than you have proposed.
So I would put it in the perspective of looking at what is the actual shortage of homes affordable and available to the lowest income people, and we know that number is 7.2 million unit deficit of homes affordable for the lowest income people. So that is the root of the affordable housing crisis. The lowest income renters are the only segment of the population for which there is an absolute shortage of homes that are affordable and available to them. And until we build rental homes affordable for these lowest income households, we will not solve the housing crisis. $3.5 billion for the National Housing Trust Fund is a good, really significant start towards ending homelessness and housing poverty, but even that level of commitment would not build the number of homes necessary to end homelessness and to end housing poverty. So I think it's a necessary increased investment to start taking the steps towards building the homes that are needed to solve this crisis.
So again, let me ask you to put that in more context. There's a lot of ways in which we build affordable housing, including the low-income housing tax credit. There's a lot of stuff out there. It's pretty fragmented. How does 10 basis points and $3.5 billion commitment interact with those other things? I guess what I'm asking is that the right way to do? Is that the right number and the right way to do it, or should we think, if we want to be efficient and effective, of also increasing or instead increasing the amount of low-income tax credits available? Give us a little bit more context on that.
So there's a number of programs that are effective at alleviating the housing crisis, and each of them are important. If you look at HUD's budget over the last 10 years, or even go back further than that, you can see there's been a rapid, really significant decline in funding for programs that house the lowest income people. There's a chart in my written testimony that shows just over the last 10 years, since the Budget Control Act was enacted, the level of cuts that we've seen to HUD's budget. So the programs within HUD's budget need to be protected and expanded where possible, but certainly with the Budget Control Act and other limits in appropriated funding, we wouldn't want to see programs like the National Housing Trust Fund competing with limited and dwindling resources. Just as an example, the public housing capital repair dollars have been cut by more than half over the last 10 years, and we see the result of that today with significant needed repairs in the public housing stock across the country. The Low-Income Housing Tax Credit Program is another important program that builds and preserves housing that's affordable to the lowest income people. The National Housing Trust Fund is unique in that it is the only federal housing production program that creates or preserves rental homes affordable for those extremely low-income households. These are households for which the private market cannot on its own build and maintain homes that are affordable to them, and where federal subsidies are necessary. The current funding for the Housing Trust Fund, as you know, comes from Fannie and Freddie, a 4.2 basis point assessment. That funding has been slightly increasing in recent years. We are now in the third year where funding for the trust fund has been allocated. It's about $269 million nationally. So it's an important program. It's building the homes that we need for the lowest income people, but it is woefully underfunded given the extraordinary need.
Thank you, and I'm out of time, so I'll yield back.
Gentleman's time has expired. With that, we go to the gentleman from California, Mr. Royce is recognized for 5 minutes.
Thank you, Mr. Chairman. So I feel like we've been here so many times, and it's become cliche, I guess, to say that housing finance reform remains the great undone work of the housing crisis. But I think this work's too important to be left undone. I very much regret, Mr. Chairman, that we were not able to resolve this issue during my time here in Congress, but I would like to caution against making a bad situation worse. And my big fear is that we do not learn from the past. In 2003, I introduced legislation, and again in 2005. In 2005, it was in the form of an amendment, which would have reined in the GSEs, allowing them to be regulated for systemic risk. If you'll remember, the over-leverage reached over 100 to 1. We saw the outsized political pressure that they were able to bring. And they won out the day in terms of their ability to constrain our efforts to regulate them for systemic risk. Today, the GSEs are again lobbying Congress, and they're lobbying the administration. And my concern here is they're lobbying to recap and release them into the market with few, if any, reforms. While many believe the GSEs are prohibited from such activity, there is no explicit ban in law. And that is why Representative Velasquez and I have introduced H.R. 7382, the Fannie Mae and Freddie Mac Lobbying Regulation Act, which will prohibit the entities from any lobbying while in conservatorship or receivership. And I am hopeful that Representative Velasquez and others will carry forward this bill in the new Congress. I was going to ask a question of Mr. DeMarco, and that is that I am concerned that Congress and the administration may not remember where we came from. And now, in retrospect, with what we know, I know that Hank Paulson and Barney Frank and just about everyone in between agreed that the GSE model pre-conservatorship was fundamentally flawed. Today, we are largely able to restrict the flaws through the power of conservatorship. I wanted to ask you a series of questions related to the possibility, Mr. DeMarco, that the GSEs are released out of conservatorship without congressional action. If the GSEs are released, would the administration be able to set appropriate capital levels? As you know, unlike banks, FHFA is not currently authorized to consider systemic risk in its capital levels. Might that present a challenge?
Mr. Royce, I would say yes. The basic issue of if there was found a path to release Fannie Mae and Freddie Mac from conservatorship absent any congressional action, we're going back to a very broken model that is imbued with a great deal of systemic risk. And I go further to say even in conservatorship, operating as they are today, we are seeing an increasing amount of systemic risk. I had an opportunity to testify before this committee in September on that very point. And yes, to your final point, that systemic risk is certainly developed, fertilized, if you will, by having capital standards for Fannie and Freddie that diverge materially from the rest of our regulated financial institutions, because it causes that risk to migrate there, and it creates a great deal of imbalance in our financial system.
So the other challenges I see there is in restricting lobbying activities. If we look at government-sponsored enterprises, either here or in Japan some years ago with their government-sponsored enterprises, you ended up with a lobbying giant that was able to prevent effective oversight. The other concerns I see is properly setting G fees going forward to prevent price discrimination against smaller lenders, constraining the affordable housing mandates, which were at least part of the reason the GSEs expanded into Alt-A and subprime, eliminate all of the benefits that come with the charter, including their tax-exempt status or their pre-crisis line of credit with Treasury. These are issues that I think are out there if this were done by fiat, and I'd ask you for your thought on that as well.
I certainly agree with all of that, Mr. Royce. I was certainly, not as a member of Congress, obviously, but as a federal civil servant and policy analyst and expert on these risks. I was up here working with you and others on this committee 10, 15 years ago, talking about the systemic risk in the system, talking about the exposure this created, not just for taxpayers, but for the home buyers and for our financial system, and we have had to live out that reality.
I very much appreciated your efforts between 2003 and 2005 and on up until the final implosion. But thank you very much. I yield back. My time's expired.
Gentleman's time has expired. That would go to the gentleman from Maryland. Mr. Delaney is recognized for 5 minutes.
Thank you, Mr. Chairman. I want to thank all of our witnesses for being here today to talk about this very important issue and the specific piece of legislation that I had the privilege to introduce with my friend from Connecticut, Congressman Himes, and the chairman. So I appreciate you all being here. A few months ago, The Economist wrote an article, and they talked about how it was at a time of volatility in the markets, and they talked about how volatility exists in markets, but one market is unique, and that is the U.S. housing market, because if there's volatility in the housing market, unlike other markets, the taxpayers are on the hook. And what this bill codifies, in my judgment, is something that's very important, which is that, in fact, the U.S. government will continue to provide support for the mortgage market so that we ensure that Americans have access to a 30-year fixed-rate mortgage. But that doesn't mean we should ignore our responsibilities to make the housing finance market, which is the second largest fixed-income market in the world, as strong and as predictable as possible. And I think this bill is a terrific bipartisan effort to do that. And that is one significant issue in the housing market that we have not, in fact, addressed, which is that it is an enormous market and it does not have a long-term framework in place for it to be stable and predictable and to ensure that consumers have access to mortgages at competitive rates at all times. And this bill does that, and I think it's incredibly important. The second problem we have with housing in this country right now is we have a crisis in affordable housing, a significant and growing crisis in affordable housing. And this bill, this bipartisan bill, creates in my judgment, a path or a road ahead where we can actually begin to do what we should be doing, which is to increase to a meaningful extent our investment in affordable housing. And through the mechanism that's been created in the bill, we can create significant additional investments in liquidity in affordable housing and help the American people who are struggling so hard to find places to live near where they work. Everyone's pretty much aware of this crisis. So the argument against bipartisan housing finance reform falls into two categories. One, kind of this ideological view that there should be no role for the federal government in housing. Well, that's kind of an intellectually interesting argument. It's not practical, and it's not productive. And on this issue and so many other issues, we have to stop letting the extremes hold the rest of the country hostage to real progress that has to be made on incredibly important issues in this country, like this issue in front of us. The second argument against bipartisan comprehensive housing finance reform is this notion that the transition risk is too great. But by definition, that argument can be used against any transformative change we want to make in public policy in this country. Of course the transition risk is significant. This is a very big market, as I said. Next to the U.S. Treasury market, it's the second biggest fixed income market in the world. And we would love for it to be the biggest, because if it were the biggest, that would mean that our debt would be lower, and that would be a good place for us to be. So I guess my question to Mr. DeMarco is, how do you assess this transition risk? Because of everyone on the panel, you probably have the most insight into this because you actually manage these enterprises. And so you've thought, I suspect, in great detail about how this transition could go. So could you give me your observations on how significant that risk is?
Thank you, Congressman Delaney. I think your whole summation is really spot on about the bill, what we have to do, and what we're facing to try to get legislation done. With respect to the specific risk of transition, I agree with you. If we're not willing to take transition risk, we'll never change anything. But that said, we all ought to be mindful and prudent in how we go about that. I think that's eminently doable. In my written statement, one of the suggestions we made for enhancing the discussion draft was to alter the timing of things that are in there to accelerate the work on getting the data and the infrastructure you envision in the exchange done quicker to allow the private market side to make further development before the rest of that transition starts. That would really help to reduce this transition risk. But I think doing that, taking adequate time to do this, which the bill certainly allows, and allowing regulators to exercise judgment about the timeline, if for some reason something is not going at the pace we expect, are all ways of easily mitigating that risk.
Thank you. I yield back my time.
Gentleman's time has expired. That would go to the gentleman from Ohio, Mr. Davidson. Is recognized for 5 minutes.
Thank you, Chairman. I really thank our witnesses and so many people that have devoted long professional careers to trying to make sure that the American housing markets and capital markets function cooperatively. And the idea that there's a distinction there highlights the fact that the risk is in some ways all mixed up in a pile instead of being bifurcated. Americans embrace a social safety net broadly, but on the back end, once these assets are held and therefore attempted to be traded in any number of forms, it's hard for markets to discern the nature of that risk. And I think we could improve that by emphasizing clear, sound underwriting principles in the market portion of the pool, and then making clear in the portion that is part of our safety net programs these are coded differently. For example, if non-voting shares are listed, often they're listed in a different way than voting shares in markets. So in this way, I think I'd like to look at how it's rational when you look at the economy performing the way that it's performing, that we're going to spend roughly $10 billion more on federal housing subsidies this year than we spent when we had 10% unemployment. Ms. Gentle, why would that be rational?
I think it's irrational not to. I think there's a few things to say about that. One is that we have increasing research that makes a very strong case for how central housing affordability is to the outcomes of so many other areas of our lives. And
has there been massive inflation in housing that's out of line with the undermarket? Has there been no opportunity for people to earn more money and pay for housing?
So when we're talking about extremely low-income renters, first, we should recognize that about half of them are seniors or people with disabilities that are on extremely limited fixed incomes. Most of the rest are in the labor force. Many of them are working very low-wage jobs, the kind of jobs that it's difficult to cobble together enough hours in a week or in a month to make ends meet. And when we look at the jobs that the Department of Labor projects to have the greatest growth over the next 10 years, we find that 7 out of 10 of those jobs pay less than what it costs to rent a one-bedroom apartment throughout the country. So there is a gap, and it's growing, between what people earn and what rent costs.
Okay, well, I understand the nature of your work, and I appreciate that we have a federal housing program that provides affordable access to homes. I think people broadly support a safety net, but I'm very unconvinced that the demand for affordable housing should be growing while the economy is flourishing. It seems they should move in the same direction. Maybe not at the same pace, but directionally they should be moving in the same way. Mr. Calcaterra, you said in your testimony there should be a prohibition against special underwriting deals and variances that put certain lenders at a competitive disadvantage and create unnecessary risk for the GSEs. The GSEs or any guarantees should also be required to be completely transparent. How can policymakers ensure that underwriting standards and criteria are set on a transparent and level basis across the industry?
What we're afraid of is that we'll return to what we had in the past. And what we're seeing is still some differentiation between different lenders working with the current GSEs. So our concern is under a structure where you increase the number of GSEs, that you're going to have a more inclination to have different negotiated contracts that will provide an unlevel playing field.
Okay. And, I think, Mr. Pollack, when you were talking about in your initial testimony, I think the point of the underwriting principle is the originator at the most basic level holds the risk is a safeguard, and I guess I was hoping to look at that. And on the back end, when you look at the credit risk transfer products that are out there, that does help de-risk the individual investor. I think that we could make those markets flourish and be more broadly accessible to the capital markets if we could make it easier to discern the risk. This is the pool that has our underwriting principles that are distorted by our safety net, i.e. subsidized, and this is the pool that is subject to sound underwriting. Mr. Michel, would you care to comment on that?
Well, that makes more sense. That's more rational, and that's a better way of going about it. Keeping the affordable stuff in one place through one agency, perhaps the FHA, which is what it was supposed to do, and there is a role for government, and that is providing that kind of framework.
Well, thank you for that. My time has expired, and I yield back.
Gentleman's time has expired. With that, we go to the gentleman from Washington. Mr. Heck is recognized for 5 minutes.
Thank you, Mr. Chairman. Ms. Yanel, I want to ask you a question about transition risk and set it up with the following. For the last year and a half, I had the privilege to co-chair the New Democrats Coalition Housing Task Force, which yielded a report here several months ago entitled Missing Millions of Homes. Basically, among our conclusions was as follows, that for the last several years we've had this bizarre situation in which demand exceeded supply. We simply weren't creating enough housing units to meet the demand. It wasn't a question of eligibility for loans, there just weren't enough homes being created. And as a consequence, we saw for quite some time a significant spike in cost. We also figured out that the provision of housing is actually a whole cloth operation. It's an ecosystem. And I'm going to get to where this relates to you now. So if supply is not meeting demand, and I would argue that it was especially documented at the starter home level for economic reasons, I'll get into that in a minute, that means that people were stuck in the homes or the apartments they were in. If you couldn't move up, you stayed where you were. If you had a middle-class home, you wanted more and could afford it, you couldn't find it, although that was the part of the market that was probably functioning best. Starter home to a bigger home, you couldn't do it. Or renting into a starter home, you couldn't do it. So you stayed renting. And what happens when people stay renting? Occupancy goes up, and so do rental costs. And the more rental costs go up, the more burdened people are. And that's part of why I think your point of view that we're simply not anywhere near meeting the demand of low-income people was exacerbated very considerably. But it also brings me to another conclusion, which is unless we deal with market rate housing, the people that you advocate for are never going to get out of the hole, and we couldn't increase the G fees enough. We couldn't provide enough federal subsidy for low-income housing unless we deal with the whole market. So that's my setup. As it relates to transition risk, I am concerned, and I'm wondering if you are, and if you are, to what degree, what happens to the GSE role in meeting the construction needs or the financing needs of multifamily? Because it seems to me that the multifamily feeds much more directly into the rental market. They have had a role, it's an increasing role, where there's been more construction. Are you acutely, particularly concerned with respect to a transition risk as it relates to multifamily, as it relates to people who rent, as it relates to people who are low income?
So yes, to some degree. I think you raise a lot of very important points, and I appreciate you raising them. You're absolutely right that the housing system is an ecosystem, different segments, there are different needs along a spectrum, all of which are interrelated and interlocked. And when one part of the system fails or near fails, it impacts everyone, but most often the most severe impacts are felt amongst the lowest income people.
Sure, they're hurt the worst.
It's like a game of musical chairs, right? And when the music stops playing, it's the lowest income people that are left standing without a home.
Agreed, but we don't meet their needs unless we deal with the whole system, is my point.
Yes, and I agree. And even when we deal with the whole system, I mean, we can also talk about zoning, the restrictions on the supply of any type of of homes, much less affordable homes in some communities, and the direct impact that's having on increasing rents and how that's squeezing the lowest income people the most. Absolutely, and that should be addressed as well. Even if we address both, the needs of the lowest income renters will still not be met. That is where there is a need for government intervention.
Agreed.
Subsidies.
I have 1 minute left. I want to get to one other question. Thank you so much. Mr. Malt, I think I'm going to pick on you for this. As it relates to transition risk, we have a nominee designate for heading up FHFA who has for a sustained period of time advocated for the dissolution of the GSEs and against a 30-year fixed government-backed mortgage. Are you concerned insofar as I think I accurately or correctly heard the chair at the top of this hearing announced that that individual would have the unilateral authority to implement his point of view? Are you concerned at all? If so, how concerned that somebody that has taken the diametrically opposed position that you've advocated here today may be in a position to implement and pull that trigger?
So the National Association of Realtors are in support of proposals like we've seen here today, and we would vehemently object to the direction that this person has espoused. Hopefully, when they get closer to the position, if they do, that changes.
Well, my time is up, but as I've said here before, we've all been to that movie before, and it didn't turn out very well. Cautionary note. I yield back, Mr. Chairman.
Gentleman's time has expired. With that, we go to the gentleman from Indiana. Mr. Hollingsworth is recognized for 5 minutes.
Well, good afternoon. I appreciate everybody being here. I want to get through a lot of topics. The first thing I want to talk about, though, is about how special our mortgage market is and our home ownership rate is. right? That's what I hear people come in and say and talk about how special this is, and we can't change anything about it because it is special. What it reminds me of is I talked to a CEO of a now successful technology company, but a previously unsuccessful technology company that said he spent 10 years working on a piece of software, adding all sorts of special features, but what he found out was it wasn't special in any way to the customer. And that's what I worry about here, is we build a really special housing system, but I don't know that it has a special meaning in home ownership rate, a special meaning to our customer at the end. And I wonder if Mr. Pollack might talk a little bit about home ownership rates in America versus those around the developed world.
Thank you, Congressman. I have made a study of international housing finance systems and how they relate to the U.S., and the thing we immediately find is that home ownership rates in the United States are in the middle of the pack as far as advanced countries goes. We're not special, or sort of on the low side of the middle of the pack.
We're on the low side of the middle of the pack, yet our intervention and government guarantees far exceed those of most of the developed world. Not all, but most.
Yes, that's absolutely right, Congressman. But if you look at comparative housing finance systems, we see that our intervention with government guarantees and GSEs are unique. We're the only housing finance system that put government-sponsored enterprise at the dominating center of the system. That was a mistake. It's clear, and we shouldn't repeat it.
And others make this argument, which I think is very specious, that say, oh, European countries also support their housing finance systems because they guarantee deposits, just like we do in the United States, right? They have implicit too big to fail guarantees, just like we shouldn't have, but do have here in the United States as well. I mean, do you see any ability for us to argue with credibility that they're supporting their housing systems to the same level that we're supporting our housing system?
Other countries often have a lot of low-income housing support, but what they don't do, and which it's a mistake to do, Congressman, is to distort housing credit by, in order to make people more loans that they're likely not to be able to repay. Right. That's one of the worst things you can do for somebody, is to make them a loan they can't pay.
For both those individuals and the financial system overall. Well said. I wanted to come back to Ms. Yentl for a second. I was frankly aghast at this sentence in your testimony. Without government intervention, decent and affordable homes cannot be reliably built, operated, and maintained at a price that the very lowest income workers, seniors, or people with disabilities can afford. The private market cannot, on its own, solve this persistent market failure. To call it a market failure is a really bold statement to make. Tell me why it's a market failure.
Well, because the private market, as I say in the testimony, cannot on its own build and maintain housing that's affordable to people who are extremely low income. Because when we're talking about extremely low income households, we're talking about, for example, an individual with a disability who's relying on $9,000 a year. That's their sole source of income.
Reclaiming my time. So to skip to the end, they can't build it cheap enough in order to justify the lowest of rent.
You can't maintain it based on the rent that a low income person can pay.
Right. You can't build it at a cheap enough rate in order to be able to make that work. Mr. Howard, you earlier talked about the huge number of people that could suddenly afford a home if the cost of that home came down by $1,000, right? One of the things I was astounded by in your testimony and some of the other reports is that 25% of the median home price in this country is regulatory burden alone, not just at the federal level, but also the local level. Something my home builders talk about all the time back home is land use restrictions, all the regulatory burden that they go through, the building permit cost, the local building permit cost. And Mr. Brooksman, I know that you know the financial side of this as well. It's not just the cost of the home, but the cost of getting financing for that home in the long run. And over the last 10 years, it has been inescapable that that regulatory burden, both at the construction level and at the financing level, has increased, right? Which is continuing to drive what Ms. Yentl's concerned about, that lower income individuals, starter homes, are getting much more expensive. They're getting much more expensive back home in Indiana. They're getting much more expensive across the country. But instead of continuing to throw more money at the problem and build units for an astoundingly high $115,000 per unit, when the average rental construction cost across the country is actually $86,000 per unit, what I'd rather see is us support lower income individuals and enable the members that you serve so well to be able to do more of what they know how to do, which is build homes effectively, cheaply, and safely, and finance those homes effectively, cheaply, and safely. So this isn't just a question of building a better system overall, It's about, as Mr. Hecht well put, an ecosystem and ensuring that you guys have the ability to be able to serve the people that she is most concerned about, that I am most concerned about, in the right way. And with that, I'll yield back my time.
Gentleman's time has expired. With that, we go to the gentlelady from New York, Ms. Maloney, who's the ranking member of Capital Markets.
Thank you very much, and I thank the chairman and ranking member for calling this meeting and for all the panelists today. I am very pleased that the sponsors have put forward a proposal for GSE reform, but I have a number of serious concerns with the bill as drafted. In particular, the lack of attention paid to multifamily housing to me is troubling. Multifamily housing is incredibly important to my district in New York. Most people live vertically, not horizontally, and most people rent. It's also very important for low-income families who can't afford to buy a home yet and who choose to rent instead. The vast majority of rental housing comes from the multifamily housing market. And if I recall, Mr. DeMarco, in the financial downturn, multifamily housing in the GSEs never went under. It continued to be prosperous and vibrant. Is that correct?
That business segment, yes, Congresswoman.
So while I'm encouraged that this bill would seek to largely preserve the current multifamily housing business of Fannie and Freddie, I believe we need to do much more to encourage the construction of affordable housing rental units for low and moderate middle-income families. And so I'd like to first ask Mr. Howard, as you know, the bill only contains one section on multifamily housing, and that section is simply a statement of principles, and it's very vague. You said in your testimony that you would like to see the committee, quote, flesh out the details, end quote, of this section. So what specifically do you think the bill needs to include in order to ensure that the multifamily market continues to function vigorously? Government guarantees, a specific section on risk sharing. What details do you feel are needed to be fleshed out in this bill? And I invite others to comment too.
Ms. Maloney, we believe obviously that the risk-sharing principle has to be fleshed out specifically. And to Mr. Hecht's point earlier, there is a whole ecosystem in the construction of multifamily housing as well as single-family housing, but it's much more complicated with multifamily that has to be incorporated into the principles of this bill. Risk sharing, rent costs, working with the low-income housing tax credit and other production programs. There has to be an integration across the board. The bill right now is largely silent to all of these things, and it's something that we look forward to working with the committee on.
Well, I invite you and others in the committee to submit to the committee your suggestions to the chairman and the ranking member for this section. It's one that I think is incredibly important. Mr. Malta, this bill appears to leave open the possibility that Ginnie Mae issuers could choose to only accept loans from certain geographic areas or create other ways to so-called cherry-pick the best risk. FHFA or Ginnie Mae would have some discretion to limit such behavior, but it's unclear how this would be adequately enforced. Are you concerned that this kind of behavior could limit access to credit for certain populations, Mr. Malta?
Yes, we believe there should be access to credit in all markets at all times and price it accordingly. So that would be a concern of our realtor members.
And Mr. Becksmith, can you comment on this as well? Are you concerned about the possibility of cherry picking?
We believe that the credit should be available in all markets and at all times as well. And a note on cherry picking, we are concerned that the current siloed approach to affordable housing in the federal programs results in some of the credits that should go to FHA going to Fannie Mae and Freddie Mac and creating some adverse selection at FHA. So we believe that this should be looked at across the whole continuum of federal housing programs.
And Mr. Becksmith, lenders have often voiced concerns about the administrative burdens and complications in ensuring compliance with various federal requirements in the context of a fragmented regulatory system. And this GSE reform proposal would assign FHFA to regulate the private credit enhancers, while Ginnie Mae would regulate its issuers? And do you think that this bifurcated and somewhat confusing, at least it's confusing to me, system of regulation is ideal, considering the direct impact that private credit enhancers could have on Ginnie Mae issuers and vice versa under this proposal?
Well, we believe that there should be a guarantor model as opposed to an issuer model, as I stated in my testimony. And in that way, the FHFA would regulate whatever becomes of Fannie Mae and Freddie Mac, as well as any future guarantor who would have to meet the capital requirements that are being promulgated by FHFA now.
Well, my time has expired, and I thank all of the panelists and Mr. DeMarco. It's a pleasure to see you again. Happy holidays to everybody.
Gentlelady's time has expired. Then we go to the gentleman from Kentucky, Mr. Barr, recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you to the ranking member. Thank you to everyone responsible for holding this hearing. Obviously, a very important topic that 10 years on from the financial crisis, we continue to need to deal with GSE reform, and appreciate all of the witnesses for your insights today. Happy holidays, Merry Christmas, season's greetings to everyone. I want to just instigate a debate really quickly between Dr. Michelle and Mr. Malta, Mr. Brecht-Smith, and Mr. Howard. My understanding is the three organizations represented here have long held that we need a federal backstop, a government guarantee, in order to provide for that liquidity, that consumer access, and to maintain the 30-year fixed rate mortgage. Let me invite Dr. Michelle to start the debate by telling us why he believes that is not the case. And in response, I invite any of the three gentlemen who I just mentioned, when you respond to Dr. Michelle, I would invite you all to address his very important point about misallocation of capital and overinvestment. So Dr. Michelle, why don't you start us off?
Sure. In terms of why do we need or not need it, the numbers simply don't bear it out. The numbers don't show a drastic drop in home ownership because of a lack of a guarantee. They show the same, basically the same stable long-term home ownership rate without an explicit government guarantee. So, I mean, it's pretty clear cut as far as the evidence goes.
How about the 30-year fixed rate mortgage issue, and in particular, Dr. Michelle's argument earlier that this does create an overinvestment or a misallocation of capital? Mr. Malta.
The 30-year fixed rate mortgage would not exist without GSEs. It's not time to go back to 1933.
But they do exist without government guarantees. They're in the jumbo market. They do exist.
The United States is the only country, with the exception maybe of Denmark, that has a 30-year fixed rate mortgage.
And I would also add that the private label security market is a $700 billion market on a $70 billion market out of a $1.6 trillion market. So yes, they exist in pockets, and yes, some banks choose to portfolio a limited amount of them, but it's nowhere near the supply that is required for the average American to have a 30-year fixed rate mortgage.
Mr. Howard, did you want to jump in on this one?
We believe, like our friends at the Realtors and the mortgage bankers, that the existence of the federal guarantee brings the cost of housing down in the international capital markets where there are investments made by foreign investors. Having that guarantee is crucial to keeping that market alive.
Let me move on really quickly because my time is running out. Mr. Pollack, I was interested in your point in your testimony that you would like to see advancing structures with lender skin in the game on the national. Does this bipartisan act achieve that? And if not, what would you recommend?
Thanks, Congressman. In my opinion, it does not achieve it. And as I said in my testimony, I think we need to encourage in all ways this superior structure where the original lender who's got the most information and knows the borrower best stays on the hook for a serious part of the credit for the life of the loan. These structures do exist. I created one of them myself when I was at the Federal Home Loan Banks. It works great, and they need to be encouraged. I don't recommend making everybody do that. We all have competition of different models, but that fundamental idea, I think, needs to be allowed to flourish as well as it can.
I agree, and that's not a criticism of the secondary mortgage market or the securitization process either, but I do think that is a good model as portfolio lending legislation that I promoted underscores. Ms. Johnson, in the remaining time I have, I'm curious to know from your perspective how we can increase the role of private mortgage insurance in the housing finance system to better manage credit risk and increase access and also decrease taxpayer risk. And would you have any specific recommendations on how to improve that in the bipartisan draft?
Thank you for the question, Congressman. I think one of our strongest recommendations for the discussion draft is that the PCEs that are envisioned should be entities that are going to be able to actively manage credit risk. And to do that, they really have to be taking on that mortgage credit risk at the loan level. We also think that these entities should be able to, or should be holding dedicated capital against that mortgage credit risk and be available through all market cycles. We fully support CRT that the GSEs and other entities are doing, but those are going to be somewhat spot markets. They're going to be available in certain instances and unavailable in others. And so we really think it's essential that you've got permanent sources of private capital that can really take this risk during our market cycles.
Well, my time has expired, but as we move forward with the bipartisan effort here, I certainly agree that we need more PMI and we need more credit risk transfers, and the more private capital that we can get in here, the better. Even if we do need a federal guarantee, let's make sure that private capital has a robust first loss position, and with that, I yield back.
Gentleman's time has expired. We'll go to the gentleman from California, Mr. Sherman, recognized for 5 minutes.
We need a federal guarantee. Yes, the jumbo market works well without one, but those are super qualified buyers, and the rest of us need housing too. The 30-year fixed mortgage exists because the federal government takes the credit risk while the private investors take the interest rate risk. We created a federal guarantee in the worst possible way. Socialism for the rich. There are very few supporters of socialism in this room, but let me assure you that even socialists do not support the idea that you create an entity with all the pressures and incentives of a private entity to make a profit, and the profits go private and the risks go public. So we lucked out, fell into what we should have done all along, and that is have a government entity. We ought to keep it that way. It makes a profit. That's not a bad thing. I'm not talking about creating a home buyer's tax to maximize the profit, but it does make a profit. And just yesterday in this room, we talked about this huge budget deficit. And the other issue is the cost of housing. The problem isn't that we have a 30-year fixed mortgage available to ordinary people. The problem is supply. And as long as we have a low supply, no amount of government intervention or subsidies is going to help. For example, in the rental market, what you can do is create a circumstance where you have a limited supply, so the poor people without a government voucher don't get the apartment, and the poor person with a government voucher does get the apartment, and then the politician does a meeting in front of all the people who did get the government voucher or subsidy and say, congratulations, I'm doing a great job. The problem with supply is we don't let people build housing. Zoning, NIMBYism. What we need in many of our cities is mass transit and density, which go together, rather than 4 homes on every acre. Let's see. I do have a question in here. Mr. Malta, as you know, I believe in the 30-year fixed rate prepayable mortgage. It has obvious advantages to the homeowner. Can you describe the importance of preserving this system?
So prior to FHA inventing this instrument, loans were due 2 to 5 years, completely due and payable. I had a relative that lost 200 properties as a result of lenders that would not renew them. So it provides predictability. It provides stability. It allows people to ride out markets, and it allows them to have their home paid for in 30 years amortized.
And without an we saw adjustable rates. They work for a few people, but I've seen people who the rate goes up, you don't get a promotion or a raise, and you lose your home. Mr. Stafford, can you tell us from a credit union perspective, do your members want the 30-year fixed rate mortgage?
Thank you for the question. Absolutely. It's the backbone of the mortgages that we provide. Without that 30-year mortgage, it would be very difficult for many of our members to have affordable housing, and we greatly appreciate it. We would have to, and I think the industry would have to be forced to have more non-qualified mortgages on their books, which would require more capital, which would reduce liquidity, which would limit some of our lending capabilities. So I, Tower Federal Credit Union, and NAFCU is a strong supporter of the 30-year.
Now, one issue is the assumability of mortgages. I know that many Ginnie Mae mortgages, et cetera, do not allow for assumability. Now, even an assumable mortgage isn't completely assumable because your house goes up in value. So if somebody wants to buy it, they've got to have cash or a high price second in order to assume your lower cost first. But perhaps Mr. Pollack or someone else, if we turn to the private markets and said, this is an assumable mortgage, you can't assume that the average homeowner will pay it off in 11 years or move in 11 years, the one or another, would that increase the price of a mortgage? It would certainly increase its value to the home buyer.
Congressman, there are markets that have assumable, I think a better word is portable mortgages, like Canada, for example. I believe Australia does as well. They're perfectly possible. It's a risk to the lender which has to be priced. And you let the market find that risk. Could I make one other?
No, but I'll ask all witnesses to answer for the record what effect they think it would have on how much the price would be.
Fortunately, the gentleman is about 30 seconds over his time, so the time of the gentleman has expired.
For a written answer.
Every witness can indeed answer in writing. The chair now yields to the gentleman from Maine, Mr. Pollack, when you're now recognized.
Thank you, Mr. Chairman. Thank you for everybody being here today, and Merry Christmas and Happy Holidays to everybody. And back to you, Mr. Calcichero. You folks are in the business of selling money, or lending money, as some people say it, and selling homes and insuring the money that you've loaned such that those homes can be purchased. And that's all well and good, and that's all part of the solution. I represent rural Maine. I am very, very concerned about those who are the most disadvantaged among us. Very concerned. And certainly part of the solution is to making sure that everybody has a safe and a warm place to live. If you look at families struggling to raise kids, it's critically important to have that unit supported as best we can when it comes to housing. If you're looking at someone who's trying to recover from addiction, it is critically important to make sure they have a safe place to live and a warm place to live. Now, I also know that part of helping those that are most disadvantaged among us is making sure they get the job training or the community service such that they can get employment. That is critically important, critically important. And we have an economy now that's doing very well. Up in the state of Maine, we have about 2.7% unemployment, one of the lowest rates in the country. And so there are all kinds of opportunities for individuals who have not been in the job market to be in the job market. But at the same time, we found that when it comes to various forms of subsidizing their well-being in housing in this situation, that incentives to make sure that they further their independence from government dependency and to further their quality of life and further their futures, and so their kids and their grandkids can see them becoming independent and more self-sufficient with better opportunities, we need to give people incentives. Now, with that, I'm guessing that you all have varying degrees of interest in how to, in commitments and ideas on how to do that. Ms. Yontel, let's start with you. If you don't mind, in the great work that you folks do you find that it is helpful to make sure folks who cannot afford to purchase a home but need to be subsidized in order to rent a home, do you find that work requirements or other types of requirements, job training requirements, are helpful for folks to become independent, lead better lives and better futures?
No. We find the opposite. We find that work requirements, when they're applied, whether to housing subsidies or other social safety net programs, can have the opposite effect and actually serve as an obstacle to allowing households to continue to get the homes, the food, the health care that they need.
Do you think that someone, if I may, do you think someone who is disadvantaged among us and is a rental apartment that is subsidized, if they're completely able, they have no disabilities themselves, they don't have young kids at home, they're not taking care of elderly parents, do you think it is helpful for them to get job training in their working age, to get training to do a job that might interest them? Is that helpful?
So I think if we look at who is actually either receiving housing assistance today or in need of it because they're extremely low-income renters, you'll find that the vast majority of them fall into the categories that you laid out. They are seniors, they are people with disabilities, or they are working, but they're working very low-wage jobs.
Let's talk about the folks so no one falls through the cracks. Not the folks who are working, not the folks who are in job training, not the folks who are pregnant, but folks who are of working age who have never had any requirements that they receive a job skill such that they can take care of themselves better and live better lives with more dignity. Is that a good idea?
So you are talking about a tiny sliver. If you look
I
at my
think
written testimony.
if I may reclaim my time,
Okay.
I think every life is precious. Every life. I don't care how small it is.
Sure.
Do you think for those
that's-
folks it's helpful?
Do I think that
Do you think it's a good idea to have people become independent of government programs which normally and usually traps them in poverty forever?
I think the vast majority of people
How about those who are the exception? Do you think
There's-
it's a good idea?
Do I think it's a good idea for them to find ways to increase their income? Yes. And I think we have to recognize that the jobs our economy is producing do not pay enough for somebody to afford a one-bedroom apartment. 7 out of the 10 jobs that the Department of Labor projects to have the greatest growth over the next 10 years pay less than what it costs to rent a one-bedroom.
I think in our discussion here, we can agree that it's really important to help everybody. Thank you very much.
Time of the gentleman has expired. The chair now recognizes the gentleman from Massachusetts, Mr. Lynch.
Thank you, Mr. Chairman. And I want to thank the witnesses for your help, your thoughtful contributions. I have a little different perspective. I actually grew up in public housing, low-income public housing in South Boston. My dad was an iron worker. He and my mom had 6 kids. I don't know what they were thinking, but I'm glad they did. But there were times in my family's life where, as my dad would put it, we had to save up to be poor. And if it wasn't for the old colony housing projects in South Boston, my family would have been homeless. So I have a deep and abiding appreciation for the federal public housing programs that have provided families like mine with a place to live. And I read this bill, and I noticed that the sections on fees and on restructuring the GSEs and re-engineering Fannie Mae and Freddie, very prominent, very precise, very exacting language. But when I looked for language regarding affordable housing, like Mr. Himes, who was a co-sponsor, I struggle. I struggle to find any sections here other than vague suggestions that there might be a way to preserve and perhaps create some affordable housing. So I know, Mr. DeMarco, you're a frequent flyer to this committee, and we appreciate that. I know that this bill reflects very much a white paper that you put out a couple of years ago with Mr. Bright on creating a new secondary market. And I'm just wondering, and I've read that paper, but it is silent pretty much on, you were focused on other issues, but it is silent on the issue of creating affordable housing and things like that. And I was just wondering if you had been asked, is there a mechanism within your proposal to preserve and create affordable housing? Not the old 1950s model where you warehouse all these poor people together. In my district now, and I think it's like this in a lot of places, we have unaffordable housing, and then we have low-income affordable housing for people who are destitute and qualified. Anywhere in between, you're out of luck. And so I think the next iteration of affordable housing has to make sure that we address the needs of people who are actually going out to work in the morning, and yet because the market is so distorted, you know, the little house I bought for $14,000 fixer-upper, they want $750,000 for that now. It's ridiculous. So is there a mechanism here or something that could be worked out where we actually do accept and fulfill our obligation to provide a spectrum of housing opportunities for Americans that are in a tough spot?
Mr. Lynch, I think this bill that the chairman and Mr. Delaney and Mr. Himes have put in front of us give us that opportunity to address the very questions that you are raising. You referenced work that I did while I was at the Milken Institute. I also, when I was there, published several papers, one with Mr. Bright, a couple on my own, on affordable housing. And in particular, I would summarize, you know, in just a general statement, I focused on creating pathways to sustainable home ownership. And I think that this bill gives the foundation for the next Congress coming in to add to supplement what is there, to address, excuse me, the issues that you were raising, but also to do so not in a 1950s or really even in a 1990s or 2000s way, but in a go-forward way to create, to use these dollars that are going to be made available to provide opportunities for home ownership in a more sustainable fashion. I'd be glad to share that research with you and come talk to you about it.
Happy to do that. Let me jump to something else we talked about earlier about the value of or the necessity for a government backstop. Is there any way to quantify what the delta might be? If we removed what would happen to the interest rate? Where if now that risk is put on the mortgage itself, there's no backstop there. What would happen to the interest rate if we removed that guarantee, that government guarantee on the mortgage? Anybody have an yeah, Mr. Brockman?
Well, I think we have some market indication of that now, where Ginnie Mae securities with the full faith and credit guarantee trade substantially better than even Fannie Mae and Freddie Mac with its implicit guarantee, even though that guarantee is pretty sound.
I'm not sure yet. I just want to know, what would the interest rate be if we remove the backstop for a 30-year fixed?
Higher.
It fluctuates from time to time, but
time of the gentleman has expired. The chair now yields to himself. I wish to apologize to our various witnesses. We are the hardest working committee in Congress, so I have been on the House floor managing one of our committee bills. Because of that, I was able to hear the opening statements. I missed some of the Q&A, so if some of this is repetitive, I apologize. Let me kind of go back to kind of where we all started here. Number one, we have a wide section of views, a wide section of the industry represented here. Is anybody satisfied with the status quo? If so, raise your hand. Okay, let the record show not one witness raised their hand. So clearly some of the most informed minds and some of the parties, the most significant parties of interest, believe that the status quo is not something they desire. And I guess another wrinkle on the question is it even sustainable? And by sustainable, is it going to yield affordable outcomes? Is it going to yield liquidity? Is it going to do that without ever having to have another taxpayer infusion? If that's the definition of sustainability, does anybody believe that this is sustainable on a long-term basis? Let the record show again, no hand goes up. So this is a proposal, yet again, a bipartisan proposal that contains many provisions that I myself do not like. Such is the nature of the legislative process in order to negotiate. So I listened very carefully to, again, the opening statements. Just to make sure we're on the same page, Dr. Michelle, I'm under the impression that CBO considers Fannie and Freddie paper to have the full faith and credit of the U.S. behind it. Do you agree that that is CBO's conclusion as well?
Yes.
Okay, so I just want to make sure we are at least dealing with the same facts. So there was a discussion earlier about mortgage rates. So, Mr. DeMarco, you particularly have an interesting perspective, perhaps rather holistic as the former director of FHFA. In your opinion, should this plan become law or a reasonable permutation thereof, what would be the reasonable expectation of its impact on residential mortgage interest rates?
Generally, I think it would have little impact on mortgage interest rates.
Okay, so we're not going to see it, in your opinion, go up by 100 basis points, 200 basis points?
No, Mr. Chairman, I see no reason why that would be the case.
Okay. So I know there's been a previous discussion of the 30-year fixed. I myself am not particularly wedded to it. Most of the witnesses are. I get that. I appreciate that. After 16 years, I think I figured it out. Not necessarily the perfect product for everybody, particularly if you're only going to own a home. I think the average now is 5-6 years, first-time homeowner. But having said that, this was designed to ensure that not only the 30-year fixed survived, it was designed so the 30-year fixed would thrive. Back to you, Mr. DeMarco. Do you believe that the 30-year fixed would thrive under this system?
Yes.
Okay, does anybody believe that it would not? If so, raise your hand. I'll let you have a brief comment. So nobody raised their hand, so there appears to at least be consensus that the plan as designed would perpetuate the 30-year fixed mortgage. We all know that today we are labeling, utilizing a QM patch. One of the things that have driven me into these negotiations is my fear that we are repeating many of the same mistakes of the past and putting people into homes that may not be able to afford to keep them. That is not good for taxpayers. It is not good for the economy. It is certainly not good for anybody who has ever been dispossessed of their home. So the question is, if you're going to have a QM standard, and we know that theoretically the QM patch is due to disappear in the not too distant future, what should our QM standard be? Who would like to give some granular detail there? Ms. Brooksmith.
We believe that the qualified mortgage definition should apply to a loan, whether it's a loan that's backed by the government or that it's a loan that's made purely by the private sector. And there are areas where the QM, Appendix Q, which is in the QM, does not fit for a lot of self-employed people. We're working on legislation to fix that.
I have to gavel myself down in an attempt to lead by example. The chair now recognizes the gentleman from Texas, Mr. Green.
Thank you, Mr. Chairman. I thank the ranking member as well. Thank the witnesses for appearing today. And would start with Mr. Pollack. Having studied body language in a limited way, I sensed when the chairman asked a question about the 30-year fixed rate mortgage thriving under this plan, I got the impression, to be quite candid, that you wanted to raise your hand, but you didn't. Am I correct on that, Mr. Pollack?
You are not correct, Congressman, on that, although I did want to make some comments, but they weren't germane to the chairman.
But you're of the opinion that it would thrive?
I think it would.
In a positive way?
Is whether it should.
In a positive way?
Well, the 30...
In a positive way?
The 30-year fixed rate
in a
loan.
positive way.
It's, the 30-year fixed rate loan is both
in a
positive
positive
and
way.
negative.
In a positive way.
It would thrive
In a
with the
positive
government
way.
guarantee, and it would pull capital from around the world.
So your
Keep
answer is that
inflating.
you don't think it would thrive in a positive way?
It has drawbacks. It keeps
okay.
inflating
Very good.
house prices.
I just wanted to bring some clarity to that point.
Thank you for watching my body language, Congressman.
I noticed you and I have been friends a long time. People don't know this, but he and I have a good relationship. We really do.
That's very true.
Let's do this, friends. Let's talk for a moment about the benefits of home ownership. I think this will give us some foundation for understanding why so many of us are concerned about home ownership being affordable and available to people in general. So let's talk about the benefits, and I'll share some quickly. And what I'm about to share with you, I assure you, these are not my ideas alone. I do think that some of them are beneficial, and some of them are ideas that I would synthesize. But this comes from Forbes. Social benefits. Children of homeowners do better in school. Higher test scores. That's a pretty good social benefit. Children of homeowners have lower crime rates and drug usage. That's important too. Society benefits from children living in homes. They are more likely to be involved in civic activities. These are the homeowners themselves. That's important. We want people to be involved in the communities. They are more likely to engage in local elections, more likely to volunteer. And here's one that I find very significant. The health outcomes are better. People who own homes have better health outcomes. So it really is important that we have a means by which people who don't have the blessings that you and I have benefited from. Now, you can say we all pulled ourselves up by our bootstraps. Well, that's a wonderful thing. Some people didn't get bootstraps, so they didn't get the opportunities that I've been blessed to have, and a good many of you as well. So we want to make sure that we have a means by which they can acquire home ownership for all of these reasons. And there are some others, by the way, that we don't talk about a lot. They have to do with stability in society. People sometimes do ugly things when, in the aggregate, they find themselves being locked out and left behind. They do. Need not go into great detail. So my point to you is this. This 30-year fixed rate mortgage is pretty important. Now, Mr. Pollock said that he would have 80% of the market be private and 20% FHA. Am I correct, Mr. Pollock?
That's correct.
Okay. If you agree with him using the paradigm established by the chairman, would you kindly extend a hand into the air? Does anyone agree with this? Okay, we have 3 people, 30-year fixed rate, 80% private, 20% FHA, no backing by the federal government. You want to retract your position, Ms. Johnson?
Yeah, no, we support an explicit government guarantee.
Okay. So we have 2 people, is that correct? 2 of 10. 80% oppose your position. Well, 20% support your position, including you, Mr. Pollock. Now, and I'm not picking on you, I'm sorry, you just made comments that caught my attention. So now with this said, let's go to Ms. Yentl. Why, well, maybe I can get you to respond in writing. I'm sorry, my time is up. I'll yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from Michigan, Mr. Huizinga, chairman of the Capital Markets Subcommittee.
Thank you, Mr. Chairman. I do appreciate you holding this. I don't hope that we would have an opportunity to have this hearing on Saturday or Sunday this coming week, but we shall see what the Senate does. You know, when I was a freshly scrubbed licensed realtor coming out of college with my oh-so-employable political science degree, I was taught one thing when I was going through. People aren't black. They're not white, they're not red, they're green. Now, what does that mean? They can either afford it or they can't afford it. And there should be no other determination about whether they are qualified to go and get a mortgage, purchase a house, and do those things. And that's something I've tried to apply to other areas in my life as well. And my colleague from Texas rightly points out that those that statistically own homes, have that skin in the game, will typically do better in school and in their community and all those things that we think are societally beneficial. Another issue at some point we may need to discuss is current trends away from that by millennials who want to go and rent, and we're seeing a much more rent-intensive sort of philosophy on their part. But I was struck by the chairman's question about did anybody believe that the status quo was sufficient right now? And as I recall, there was no hands that went up, left, right, or center on this. So that does beg the question, not only what needs to be fixed, but how does it need to be fixed? And can we do this without legislation? Because some have said that this is a pursuit of folly, trying to go in and fix the GSEs and address some of these things. And I guess the question is, if everybody on the panel, wide-ranging, believes that there are issues that need to be addressed, don't we need to do that legislatively, or can we do that through some rules and some other administrative reforms that could happen? And one of the questions that I have is, that I have to ask myself is, do I believe that taxpayers are at risk by avoiding a long-term solution in fixing housing financing? And that is, I know, a goal that the chairman has expressed, something that I have been very interested in as well. But Mr. DeMarco, I'd love to hear your thoughts on sort of what can we do and what should be the focus of this?
Well, for starters, Congressman, the answer to the first of that series of questions is, I believe, yes, Congress does need to be the one to finally act. Look, Fannie Mae and Freddie Mac were chartered by the Congress of the United States, and the Congress of the United States reserved for itself, not to FHFA or Treasury or anyone else, reserved for itself the authority over those charters. And so the fact that those charters and that model failed so spectacularly means that the Congress of the United States is the only one that can bring final resolution to that. FHFA and the Treasury can do a lot to help prepare the ground for Congress. I don't think of it as administrative reform. I think of it as administrative preparation, that what they can do is look at what the Congress is deliberating, and as Congress gets closer and closer to consensus, FHFA can be working to take steps in that direction where there's broad consensus, but ultimately this is going to be the responsibility of the Congress to resolve.
Dr. Michel, I know that you'd like to sort of, in a perfect world, get rid of any sort of governmental influence and effect on that. I'm not sure that that's realistic, but I understand the philosophy of doing that. And Mr. Pollack, I'd like to hear from you very briefly on that, and let's make it quick, so we got about 45 seconds. And then,
yes, thanks, Congressman. I think fixing Fannie
I'd like to hear from my
Freddie,
realtor friends.
Congressman Royce put out a list of how to fix them. I fully subscribe to his list, and those are things that ought to be done.
If we're just talking about getting an extra layer of private capital, then just release the GSEs with a higher capital requirement, not go through all these trials and tribulations, if that's what you want to do.
Okay, last 20 seconds to my realtor friends.
Yes, so we do agree that the GSEs are important, and we do agree that we need a government backstop. And I think the reason for that is because we simply, inevitably, we saw what happened even when there was a government backstop with the crash and the bailout of large institutions.
But there was a number of other issues behind that. So, and this is why we needed to have a much longer conversation. But
Time of the gentleman
appreciate it. Thank you, Mr. Chairman.
Time of the gentleman has expired. Chair now recognizes the gentleman from Missouri, Mr. Clay.
Thank you, Mr. Chairman, and thanks for conducting this hearing. And I assume this is your last hearing, and and just wanted to say that it's been a pleasure.
Well, the gentleman yielded. He said that happily?
Yes, sir, it's been a pleasure. Thank you. Let me talk about inquire about private market solutions, and I will ask the two bookends at this witness table, Mr. DeMarco and Mr. Pollack. You know, during the financial crisis, 11 million Americans were displaced from their homes in my community, St. Louis City and County. Entire neighborhoods were devastated, mostly because my constituents were steered into high-price loans. And they had balloon notes, and they were wiped out. They were forced into foreclosure. Those housing stocks have never bounced back. And home ownership rates among African Americans are at the lowest they've ever been recorded at. And so I'm wondering, do you have any solutions? And I'll start with Mr. DeMarco to address how we increase overall family wealth in the African American community through home ownership. You and I know that's the biggest thing a family will purchase. Most families in America is a home. And so does the private market have any solutions, any pathways to sustainable home ownership solutions? And I'll stop there and try to see if I can.
Well, I believe it does, and I think that you're quite right. The devastation is real. Going back to one of the points Mr. Green made, I wrote about it in one of the papers I referenced to Mr. Lynch. I mean, it's not just that they lost their homes, they had financial impact, the health impacts, not just for those that were foreclosed on, but for others in those neighborhoods that were hanging on, was dramatic. And so this needs to be something that we're all considering. So your question to me is about, does the private market have something to contribute here in a positive fashion? And I believe the answer is yes, and I believe that the private market has a responsibility and a willingness to do that. But part of that is the private markets, if they are actually bearing risk, can send better and appropriate signals about risk-taking, and we need to be open to that, right? Because we not just want to make folks homeowners and encourage and create those opportunities, we want those opportunities to be sustainable for those families. And so, yes, I think that one of the things that a bill like this does is it moves us forward in a manner that allows for the private market to actually step in and think about new ways of providing this sustainable home ownership opportunity, and for capital markets to work in a constructive fashion for our families.
And you know that will require creativity.
Yes.
And thinking outside of the box in order to ensure that potential borrowers qualify.
That's right, and not just qualify, but that they're able to sustain that mortgage once they're in.
Sure. Mr. Pollack, anything to add about private market solutions?
Thanks very much, Congressman, and I do think that the private market has a lot to contribute, and one of the things is appropriately matching price and risk and credit so that loans are good loans that pay. You know, if we'd been having this session 80 or 90 years ago, it would have featured something which we haven't mentioned a single time today, and that is savings. One of the most important things you can do to help people rise is savings. The old savings and loan movement, as it called itself at a trade association, the U.S. League for Savings, oddly, we've forgotten about the need
to improve
savings.
Mr. Pollack. Let me say this. Had I been here 80 years ago at the creation of the FHA, then we would have instituted some types of requirements that wouldn't allow them to redline or discriminate against those who have historically have been left behind from the American dream. And you and I know historically that happened.
Good point, an act of the government, Congressman.
I yield back. Thank you.
Time of the gentleman has expired. There are no other members left in the queue. Without objection, all members will have 5 days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able. I wish to thank all of our witnesses for their testimony today. Again, I apologize for having to reschedule the hearing. I would also like to thank the staff and members who have worked on housing. Particularly, I wish to thank Ed Scala, Clinton Jones of the majority staff, and Tallman Johnson, Joe Quick-Linsky, and Michael Vangeloff, the latter three who will be leaving the committee. I want to thank them for their work on this. So for the final time in the 115th Congress and for the final occasion of my chairmanship, this hearing and this committee stands adjourned.
Well, today, senators are debating